Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, April 25th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is bad corporate guidance plus stagflationary GDP equals risk off. So the nuance there is Meta disappoints investors with poor guidance. The stock is down 14% despite beating on sales and earnings. Elsewhere, the U.S. Q1 GDP report was as unsupportive of our resilient U.S. economy theme as it was supportive of our sticky inflation theme. Headline growth slowed sharply, led by a modest pullback in consumer spending and sharp decelerations in net exports and government consumption and investment. Bucking the downward trend was a sharp acceleration in private investment, which was led by meaningful advances in the equipment, intellectual property, and residential segments. In terms of market implications, it appears the Biden administration pulled back on buying votes to control the message surrounding this report. Still, the Q1 GDP report reeks of stagflation, and according to how we defined it, which is below trend real growth and above trend inflation. Nominal GDP continues to trudge along at a slightly below trend pace, which implies continued scope for companies to generate sales and profits. Slightly below trend nominal GDP growth is not necessarily bearish, unless the Fed and/or Treasury decide to curtail above-trend inflation by tightening policy. Next week's quarterly refunding announcement and FOMC catalyst will be telling in that regard. Said simply, if Jay and Janet do not want a soft landing anymore, financial conditions have considerable scope to tighten from current valuations. To that point, our positioning model signals are far less supportive of risk assets than they were when we called for the bull run at the start of November. As always, transitioning to our 42 macro dashboard here. As always, we'll wrap up with the question from our community, a global community of clients. So this question reads, given the weak GDP print, do you think this influences the gold trade? I assume weaker U.S. growth equals less demand for U.S. treasuries as a safe haven asset equals more demand for gold. So generally speaking, yes, slowing growth is a supportive dynamic for the gold price. However, the internals of this GDP report are not necessarily supportive for gold because they could pull forward any pivot by the Fed and or Treasury to explicitly tightening policy from either from a forward guidance perspective or potentially we would start to talk about rate hikes. And more importantly, from the perspective of, not more importantly, but as importantly, from the perspective of Treasury net financing policy. So this is why we're very keenly focused on next week's quarterly refunding announcement. On Monday, we'll get the targets for the TGA and issuance. And then on Wednesday, we'll get the composition for that issuance. Both of those will be very important for asset market participants to understand the Treasury's intentions with respect to medium-term net financing policy, which could have a very supportive influence on U.S. liquidity as it has for most of the past year plus, or it could have a negative influence on U.S. liquidity. So that's something we definitely have to watch in real time. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, April 25th, 2024. Best of luck out there today. Everyone have a wonderful day. And it's a big night, a big Christmas in April. So I got the draft tonight. So I'm very excited about that. Hopefully everyone's tuning in to what is one of the best events on TV. Got the emotion and all the intrigue and all the drama. It's going to be very fun tonight. So hopefully everyone have a wonderful day. We'll catch you back here tomorrow. Cheers.